Most people spend their 40s believing the window has already closed. They look at their retirement accounts, their savings balances, and the distance between where they are and where they wanted to be by now, and they quietly accept that millionaire status is something that was always meant for someone else. Someone who started earlier, someone who earned more, someone with better luck. But here is what the data actually shows. Your 40s are not the decade where financial dreams die. They are the decade where they either get built or get abandoned. And the difference between those two outcomes is almost never about income. It is almost always about three specific money moves that people either make or miss during this exact window of time. Today, I am laying out all three. And if you are in your 40s right now or approaching them, what you are about to hear could genuinely change the entire trajectory of your retirement. Welcome back. I am Warren, and on this channel, we talk about the money decisions that actually move the needle. If you want to reach your first million on a realistic timeline, hit that like button right now, subscribe, and let us get into the three moves that make it possible. Before we get into the three moves, I want to anchor this conversation in something real. According to Federal Reserve data, the median net worth of Americans between the ages of 45 and 54 sits at approximately $247,000. The median for those between 55 and 64 is around $364,000. Meaningful progress, but a long way from a million, and nowhere near the kind of financial freedom most people in their 40s are hoping to reach by retirement. But here is the other side of that data. The people who do reach seven figures by or around retirement age are not primarily people who earned dramatically more than everyone else. They are people who executed specific, high-leverage financial behaviors consistently. During the exact decade we are talking about right now, their 40s were the turning point, and these three moves are what made the turn. Money move number one, aggressively maximize tax-advantaged retirement accounts. If there is a single money move in your 40s with more direct, measurable impact on your path to $1 million than this one, I have not found it. And the reason it is so powerful comes down to three things working together simultaneously: tax advantages, employer matching, and the compounding window that still remains. Here is what that means in practice. In 2025, the IRS allows individuals under 50 to contribute up to $23,000 annually to a 401k. But here is the part that most people in their 40s do not fully take advantage of. Once you turn 50, you become eligible for catch-up contributions, an additional $7,500 per year on top of the standard limit, bringing your total annual 401k contribution capacity to $30,500. That catch-up provision exists specifically for people who are behind on retirement savings and need to accelerate, which describes the overwhelming majority of people in their 40s. Now let us run the math on what maximizing these accounts actually does to your trajectory. If you are 45 years old today and you maximize your 401k contributions at $23,000 per year, just the standard limit, not even the catch-up, and your account earns a conservative 7% average annual return, you would accumulate approximately $470,000 in that account alone by age 65. Add a working spouse doing the same thing, or add your IRA contributions on top of that, and the picture changes dramatically. But the full impact is even larger than the raw numbers suggest because of the tax advantage. Every dollar contributed to a traditional 401k reduces your taxable income in the year it is contributed, meaning the government is effectively subsidizing your retirement savings by the amount of your marginal tax rate. For someone in a 24% tax bracket contributing $23,000, that is roughly $5,500 in immediate tax savings every single year. Money that would have gone to taxes is instead going to work in your investment account. And then there is employer matching. If your employer matches even 50% of your contributions up to a certain percentage of your salary, capturing that full match is an instant 50% return on those dollars, guaranteed before a single investment gain is added. For someone earning $70,000 with a 3% employer match, That is $2,100 in free money every year that most people leave on the table because they are not contributing enough to unlock it. The action for this move is simple but urgent. Calculate exactly what you are currently contributing to your retirement accounts. Then calculate the gap between that number and the maximum contribution limit. Then build a specific dated plan to close that gap as aggressively as your budget allows. Starting now, not next year, not when things settle down. Because every year you wait to maximize these accounts is a year of tax-advantaged compounding that you can never recover. Money move number 2. Eliminate high-interest debt and redirect every dollar freed up. This move is the one most people in their 40s are already aware of, and the one they are most likely to keep pushing further down the road. And the reason that delay is so financially devastating comes down to a math problem that works against you every single day you let it continue.
High-interest consumer debt, primarily credit card balances, typically carries interest rates in the range of 18 to 24% annually. The historical average annual return of a broadly diversified stock market index fund sits at approximately 7 to 10% over the long term, which means as long as you are carrying high-interest debt, the drag it creates on your net worth is growing faster than your investments. You cannot build $1 million while 20% interest is running in the background. The two are in direct mathematical conflict. Here is the reframe that makes this move click for most people. Eliminating a credit card balance carrying 20% interest is not just getting out of debt, it is generating a guaranteed risk-free 20% return on every dollar you apply to it. No investment available to everyday investors can reliably deliver a guaranteed 20%, which means attacking high-interest debt is investing, arguably the highest return investment you can make with any dollar you currently have access to. The strategy for this move in your 40s is specific. List every debt you carry, along with its current balance and interest rate. Rank them from highest interest rate to lowest. Direct every additional dollar you can free up, from spending cuts, from extra income, from any windfall that arrives, toward the highest rate debt first, while maintaining minimum payments on everything else. This is called the Avalanche method, and mathematically it is the fastest and least expensive path to debt elimination. But the move does not end when the debt is gone. The critical second half of this move is what you do with the money that was going to debt payments the moment those payments disappear. Because the temptation, the powerful, socially encouraged temptation, will be to upgrade your lifestyle now that you have breathing room, a better car, a nicer vacation, more freedom to spend. Quietly wealthy people do something completely different. The moment a debt payment is eliminated, they redirect that exact dollar amount, every penny of it, into their retirement accounts or their investment portfolio. The payment does not stop, the destination changes. And that redirection, compounded over the remaining years of your 40s and into your 50s, is one of the most reliable mechanisms for closing the gap between where most people end up and where millionaires do. Money move number 3. Build or maximize a real income-generating asset outside your primary job. This is the move that separates the people who get close to $1 million from the people who actually cross it. And it is the one that most financial content either glosses over or frames as something only special people with special skills can do. It is not. Here is the reality that the data on American millionaires consistently supports. The majority of self-made millionaires have more than one source of income. Not because they are greedier or more ambitious than everyone else, because they understand something fundamental about how wealth compounds. A single income stream, your salary or your wages, has a ceiling. It grows when your employer decides it should grow. It stops the moment you stop working. And it is completely dependent on circumstances outside your direct control. An income-generating asset, on the other hand, earns money independently of your time and your employer's decisions. And your 40s are the ideal decade to build one, because you likely have more income, more professional knowledge, more real-world skills, and more credibility than you did in your 20s or 30s. You have something of genuine value to offer that did not exist when you were younger. What does an income-generating asset look like in practice? It varies based on your skills, your resources, and your risk tolerance, but the categories are consistent. Real estate that generates rental income exceeding its carrying costs. A dividend-focused investment portfolio that throws off passive income quarterly. A side business built around a professional skill or area of expertise that generates revenue without requiring your full-time presence. A digital product, a course, a book, a subscription resource that earns money after an initial creation investment. Intellectual property that generates licensing or royalty income over time. The key principle across all of these is that the asset must generate income that does not require you to trade time for it continuously. You may invest significant time to build the asset, but once built, it should earn with minimal ongoing effort, because that is what separates an income-generating asset from a second job. In your 40s, you do not need to build an empire. You need to build one asset, one real, functioning, income-producing addition to your financial picture, and then nurture it for the remainder of this decade and beyond. Even a rental property generating $500 per month in net cash flow, or a side business generating $15,000 per year, or a dividend portfolio paying out $800 per quarter changes your retirement math in ways that salary increases alone almost never can. Because here is what an additional income stream actually does beyond the money itself. It reduces your dependence on any single employer, which gives you more leverage in your career, more freedom to take risks, and more ability to weather economic disruptions without panic. It provides income that can be redirected entirely into retirement accounts and investments because your primary job is already covering your living expenses. And it builds compounding momentum that, over a decade, often surprises even the person who built it with how significant it becomes. The action for this move is not to research every possible income-generating asset endlessly before starting. It is to identify one based on your skills, your resources, and your honest interest, and begin building it this month. Not perfectly, not with a complete plan, just begin. Because the asset you start imperfectly today will be further along in 5 years than the perfect asset you are still planning in your head. 3 moves. Maximize your tax-advantaged retirement accounts with urgency, especially if you are approaching or past 50 and catch-up contributions are available to you. Eliminate high-interest debt with a specific strategy and redirect every freed-up dollar immediately into investments. And build one real income-generating asset outside your primary job that earns independently of your time. None of these moves require a 6-figure salary. None of them require extraordinary luck or specialized access. They require clarity about where you stand, a specific plan for each one, and the discipline to execute that plan consistently through your 40s, even when other priorities are competing loudly for the same dollars. Your 40s are not too late. They are exactly the right time. The compounding window is still open. The catch-up provisions are designed for this moment. And the habits built during this decade will determine not just whether you reach $1 million, but what the rest of your financial life actually looks like. Which of these 3 moves are you starting first? Drop a comment below and let me know. I read every single one. And if this video gave you a clearer path forward, hit that like button, subscribe, and share this with someone in their 40s who needs to hear it before time runs out. I am Warren, and I will see you in the next one.